How do stocks perform during inflationary times? That's a question we're going to dive into. I had a guy on my YouTube channel say, hey, you don't like bonds and bonds get hammered in inflation. How about stocks? Are they a better hedge? And that's a good question. It's not as easy as you might think, my friends. I'm going to share with you a piece that I think you'll find very informative. And in fact, if you can read this whole piece and everything in its entirety, you'll know more about investing than the vast majority of people out there. I'm just telling you, it's nuts. And it's all free. It's crazy. So the issue is that comes with bonds. We know bonds are fixed income. Fixed income. What does that mean? It's fixed. That's why there is no, it's just all these people think that bonds are going to grow. They don't. They're fixed. That's why they're called fixed income. You got $1,000 bond. It pays, for simplicity, 6% a year in interest. That means $60 a year is what you're getting. $1,000, $60 a year. The $1,000 will mature at a certain point in the future, say 10 years. So $1,000 is what you bought it for. You'll get your $1,000 back in 10 years. In the interim, you'll get $60 a year in income. That won't change, and this won't change. As long as the bond doesn't go bankrupt, it cannot be any clearer than that. Bonds are so simplistic. But if we have an increasing level of inflation, that $1,000 that you purchase today will provide a whole lot less than $1,000 of value at maturity. Does that make sense? That's why bonds are not priced fairly high in high inflationary times. If you look at the 82, for instance, you could buy a 30-year treasury and get 15 and a quarter as a yield. Why? Because people said, why would I pay on a bond that is going to be worth significantly less in terms of purchasing power when it matures? And they don't want it. So the demand of those bonds was just drop like a rock in water. And like a brick in water. So because that the demand of the bonds fell, the yields on the bonds went sky high. It turns out to have been the best investment that you probably made over the last 40 years, but still, nonetheless, that's what happens. High inflationary times means high yields and low demand for bonds because people don't want to buy stuff that they're going to lose purchasing power for. It just so happened was the inflation of 80, 81, and 82, no one knew back then that it was going to go back to normal, what we're in normal now. So if you look at a graph of the inflation environment over the last 100 years in the U.S., it is like this, just a typical graph, a huge, low, huge, low again. And that's, so the question is that 70 to 80, beginning 80, is that an anomaly? And probably yes. All right, so that's how bonds work. They get hammered inflation. You're literally losing purchasing power each and every year of the bond's existence, even if inflation is low. So for you to keep break even, $1,000 you bought that bond for at 2% inflation, the next year it has to be worth $1,020. The next year it has to be worth $1,000, whatever it is, 41 or whatever. To keep up with inflation, but it's not. It's 1,000 today, 1,000 maturity, but inflation is taking away each and every year purchasing power of that bond. Inflation is also taking away each and every year purchasing power of the interest that you're making. Now, stocks, on the other hand, don't have that because we don't know the end game of stocks. It could go to zero, it could go to 8,000 million. We just don't know. And on top of that, there are dividends that are growing as well. So stocks, we can't sit here and say they are a hedge. But they could be, because as inflation kicks in, dividends will probably increase as well. And the price of the stock may or may not increase. It depends on earnings. So let's look at this thing from Bill Sharpe, and he does a study right here. Sharpe won the Nobel Prize. I'm sure he did. He won the Nobel Prize for the Sharpe ratio, the risk versus return. You'll always hear something called the Sharpe ratio. Is the return you get for the level of risk you're taking. The lower the Sharpe ratio, it's been so long since I actually cared about any of this because it doesn't matter. But I think the lower the Sharpe ratio, the more return you're getting for every quantity of risk, if that makes sense. So you want a low Sharpe ratio because that means you're getting more return for each unit of risk. Yeah, I'm sure that's what it is. But anyway, frankly, I don't care. But it's something if you're a financial guy and you want to know the terminology, the Sharpe ratios and stuff. And so Bill Sharpe won a Nobel Prize. All right, so this is what page is this? You can get all this for free. I'll show you. This is chapter 7, retirement income analysis with scenario matrices. This is chapter 7. It's just from Stanford, all for free by Bill Sharpe. It's just, I'm literally in here. You go to, and this is what I was just looking at before I did this video. 21. Here's chapter 21, which is advice I mean, you can just you enter. Actually, it's funny. Enter the financial advisor. Ideally, he or she will have a deep background in the economics of investing and spending approaches, sufficient analytical tools to determine the ranges of likely outcomes and different strategies, an ability to work with clients to find approaches that are suitable given their situation and preference. Moreover, the amount charged for providing such advice would be well below its added value. Tall order indeed. All right, so you can read all this stuff, but it's actually pretty interesting. So I'm just curious. Let's see what chapter 5. Just chapter 5 is inflation. There you go. So all right, cool. I didn't realize I was going to do that. That's fantastic. I wonder if let's see if they. Oh, what's that? Year over year CPI. This figures show year-over-year measures of cost of living in the U.S. from 1871 through 2014. Yeah, so that's pretty cool. So we got inflation right there. I like that. He's got to have one on interest rates. So let's just see. I'm going to go back to my main crux of this, what we just talked about. Is that the right one? About stocks and inflation in just a second. I just want to see interest. I was hoping to show the interest rate curve, but he doesn't. At least, I mean, I guarantee it's in here, but it won't be easy for me to find. I was hoping we could see a table of contents. Anyway, look, man, this whole thing is free. It's free. I love the internet. All right, so let's go back to the thing I want to talk about. All right, so chapter 7. Again, if you read through this, you will know more than 98% of all investment professionals out there. Never mind the population at large. Okay, so here we go. Market returns and inflation. So we've already talked about how bonds are horrible in inflationary environments, even if inflation is not that high. Real estate. See, the thing about real estate, it completely is contingent not on the inflation so much, but on the actual location. Yeah, that rhymes. Real estate not contingent on inflation, but location. You gotta get real. So we gotta make that a little bit snappier. Real estate, inflation. No, real estate, no to inflation, yes to location. I got to think about that. But anyway, you can put that in a song if you want, any musicians out there. But so real estate really depends on where you are. The facts are you can have low inflation or high inflation. You live in Detroit, the facts on inflation aren't going to affect your price of your home. You have low inflation or high inflation. You happen to live in Silicon Valley before it became the mecca for tech. High inflation, low inflation doesn't matter. It's just a matter of the demand. And that's the thing with real estate. It's really location driven. But once you're in an established neighborhood, you can look at inflationary to increase the value of your home by inflation, as long as that neighborhood stays the way it is. I had a guy and a lady I was working with, and they lived in Camden. They lived in Cherry Hill, New Jersey. It's about going on 10 years ago now. And they used to live in Camden. All right, Camden is horrible. It's horrible now. All right, and now they don't live in Camden anymore. So the home that they bought that they lived in Camden in like the 40s or 50s, that's where they grew up, I should say. It's not worth a penny anymore. No one's going to buy it. All right, so you can say inflation all day long will inflate the value of your real estate. No, it does in some degree, but Cherry Hill was where they moved because they had to get out of Camden. They had to flee. That's what happens. Is the urban decay of the 60s and 70s led the middle class to flee these places. So all the places that you grew up now are worth a whole lot less than what they were, regardless of inflation. Now Cherry Hill, Cherry Hill isn't quite as alluring anymore because it's actually an older town now. So you could probably expect an increase of the rate of inflation to these homes in Cherry Hill, but if things go worse, you could see a down. So just got to remember that. So let's look at stocks. So stocks or bonds get killed in inflation. Real estate is completely independent, in my opinion, of inflation. How about stocks? Market returns and inflation. One last question needs to be addressed before we turn to programs. Are future market real returns likely to be correlated with levels of inflation? The following figure, provided by Robert Shiller from Yale, another Nobel Prize guy, compares annual values of the year-over-year ratios of the CPI, the Consumer Price Index, with those for the Standard & Poor's Stock Index from 1871 through 2014. There is a negative relationship for the years prior to 2000, but is only barely statistically significant. with a T statistic of negative 2.21. Don't know what that is. Don't need to know. You don't, and I don't. For the first 15 years of the 21st century, the relationship is slightly positive, but again, insignificantly so. So essentially what our man Bill Sharpe is saying, there is no relationship between stock returns and inflation year over year, though. And that's what I want to discuss. And so here we got CPI and real stock price changes on any given year. Extrapolation, there is no relationship at all on any given year. So 1871 to 1999 is the blue, 2000, 2014 is the red. Here's our CPI, year over year increase or decrease. So we have a 1 there, all right? So you can see lots of increases in inflation. And then we got our S&P 500 value. What happens with, we have an increase in inflation relative to stock prices. And here we had a pretty significant increase in inflation, was at 20%, and yet we had a stock decline of 40%. Here we had a pretty significant increase in inflation of 22%, probably, yeah, about 21%. And yet here we had an increase in stocks by 20%, 18% or so. Here we had a 45% increase in stocks, but we only had basically a 2% increase in inflation. Here we had a 45% increase in stocks, and we had a deflation. So the price CPI actually went down a little bit. And so you can see there's literally no correlation between stocks and CPI inflation on an annual basis. That's what I've got to stress. No, if you cannot say on an annual basis stocks and inflation they're just not correlated. However, common sense should dictate inflation over time, 2, 3, 4, 5 years. I assure you there is a correlation there of increasing inflation and increasing stock performance over time. In fact, I would argue the longer you go out, the higher the correlation there are. Does that make sense? So the more the inflation kicks in relative to stock prices, the more the stock prices are going to grow as well. Does X lead to Y? No, not necessarily, but there's certainly a much higher correlation between inflation and stock growth, the value of your holdings growing, than there is with inflation in real estate. Absolutely. Now, there's a negative correlation between inflation and bonds, absolutely. And that would be very hard to disprove, that negative correlation between inflation and bonds. And I couldn't prove to you that the reason stock prices are going up are because of inflation. I can't prove that to you, but you can inherently make sense. I mean, inflation is causing the price of goods to increase. Causing a price of goods to increase, the price of goods that the companies sell to consumers is increasing their bottom line from a price, an inventory perspective, but it's also increasing the cost of goods sold too. So the cost of goods sold increases, the price of goods increases. They're going to get more cash from a nominal perspective, which means they have more dividends to pay. All this is nominal, and nominal means it's not net of inflation. So it might look better on paper, but in real terms, it doesn't matter that much. So there is definitely a correlation between stocks and inflation, but it's not as easy as if inflation is up 10%, my stocks will be up 10%. Not in any given year. There is none. We know that right here. There is no correlation at all. Over the course of 3, 5, 10 years, though, absolutely. As inflation increases, the value of your stocks in the whole now, not any given stock, and that's the issue here too. We're talking the industry as a whole, which should go up without question. And similar to real estate. As inflation goes up, the value of any individual home doesn't mean anything. As the real estate goes up, the value of the totality of real estate prices you would think would go up. Anyway, I hope this helps. Either way, inflation is the death of bonds. Absolutely, unequivocally, 100%. Does inflation lead to increases in stock prices? I would say yes. I think there is a correlation there, and I'm very, very willing to make an assertion on that. Will it lead to one stock over that stock? No way you can make that correlation. All right, hope this helps. Don't forget to smash the like button. Go on this guy's website. I'll put a link, and man, it's freaking awesome, all free. And you'll get more education here than you could possibly imagine. We'll see you next time.